Today's episode is brought to you by Lightyear, the investment platform I use for my stocks and shares ISA. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
You've seen the oil price soar, but crude is just the start. The Iran conflict is sending shockwaves through natural gas, fertiliser, helium, and a host of other commodities we take for granted.
We look at what it all means for inflation, interest rates, and how you might want to position your portfolio. And in today's dumb question of the week, does the futures curve predict where prices are going in the future? All right, let's get into it. So, Roman, it's finally come time for us to talk about the ongoing Iran war, about 2.5 weeks in. Now, our listeners don't know this, but we actually recorded an episode on the Iran war a couple of weeks ago, and then events overtook what we'd said, and we had to scrap it, and we never put it out. And war is always a hard thing to talk about, and I don't like talking about it. And we've been back and forth on what exactly we should say. Now, I don't want to say that we put more thought into a podcast episode than the US administration put into going into war, but I also don't not want to say that.
Yeah, I think, look, initially we should say that whenever you're talking about war, it's a tragedy. And we're going to focus on markets and economics and the impacts, but we shouldn't underestimate the unfortunate consequences of any war. So I don't think we're ignoring the human cost, because we're not. It's just not something that this podcast is about.
But what it is about, in the first instance, is oil. I think we should start there.
Now, I also made a video about this, and I kind of broke it up into two phases, phase 1 and phase 2. Phase 1 is the big spike in oil that you get and gas and the risk off move in equity markets. And then phase 2 is the kind of longer term stuff. So initially it shot up by about $10. Previously it was trading at about $65 to $70 a barrel. Then it shot up to the mid 80s, and then it shot up above 100. And it's pretty much been trading there ever since.
It's been incredibly volatile though. Intraday it got as high as $120 a barrel. Then it crashed on kind of false rumors down to almost 80, and now it's back around 100 again.
And there is an equivalent of the VIX index, which measures out of the money option premia for the stock market. There's an equivalent for the oil market called the OVX index, and that's surged over recent weeks. Now, if we look at the price of gas, natural gas, that's also gone up. Often the two are highly correlated. If oil prices increase, then gas prices increase too. And for the UK market, that's particularly problematic because we're heavily dependent on LNG imports.
And I think everyone knows the reason right now why oil and gas prices are rising incredibly fast. There's that critical choke point, the Strait of Hormuz, where roughly 20% of global oil supply has to transit, and a similar amount for LNG. So there's something like 20 million barrels a day that are at risk. Now, there's debate about how many of those barrels have actually disappeared, how much of it is temporary, and how much can be substituted elsewhere. So Saudi Arabia has turned on a pipeline that it didn't really use much in the past, but it only substitutes a little bit of their supply that would usually go through the strait.
And there have been some great humorous threads about this, about how to get around the problems with the Strait of Hormuz, where someone said, for example, explain to me, as if I were a 5-year-old, why you can't just dig a tunnel or some kind of canal through the Straits of Hormuz to just bypass it.
What, through the peninsula?
Yeah, through the peninsula itself.
Well, there's a lot of people living there, for one. You'd have to go through a lot of houses.
So the reply was, mountain hard and big, water no up, many, many dig. So I think there are really no alternatives to this strait at the moment, certainly not if you're moving large volumes of oil.
Yeah, so of those 20 million barrels a day, which seem to be at risk of crude and associated products, I think the International Energy Agency estimates that around half of that has actually been lost once you account for pipelines and other supply coming online, which is a lot. Now, in the short term, there are buffers at play here. So at any one time, there's a lot of oil floating on tankers on the oceans, which can be used. There's also strategic reserves in various countries. And obviously the IEA has said we're going to release a record amount from the reserves. But as a lot of people have pointed out, What really matters is not so much the total number of barrels you're going to release, but the flow of that into the market. And it can only come out of the tanks so quickly.
And I think geography also plays a large role here. So, for example, if you look at Singapore and you look at its jet fuel costs right now, that's hit over $230 a barrel. And that's because a lot of the oil that goes to Asia goes through this strait. In the UK, not so much. So, really, it depends on where you're located as to where the biggest pinches in supply are going to be. But to some extent, oil is a globally priced commodity. So even if you're not directly affected, the price locally may go up anyway. And the US, of course, has been subject to that problem because clearly they are almost energy independent. They're a net exporter of oil, but still they've been negatively impacted by increasing cost for gasoline. So that's gone up about 70 cents a gallon, a little bit more.
Americans seem to be exquisitely sensitive to the price of fuel. Is that because they have big cars and take long journeys?
Well, I think it's true in the UK as well. If you think about inflation and how you perceive it, it's the things you do every day. So every time you're at the forecourt and filling up your car, you'll notice the price of petrol or gasoline. And people are very sensitive to it in the UK as well.
I guess the question is, how high is the price of oil going to go? And how long will it stay high? And no one knows because it depends on the duration of the conflict and how quickly the Strait of Hormuz can be opened up again. I guess if we had some kind of ceasefire and reopening tomorrow, you'd see the price of oil fall back to kind of $65 a barrel quite quickly. Whereas if we get into a protracted conflict that lasts months and months, then, surely we're heading up to $150 plus per barrel.
Yeah, I was listening to an interview with a strategist from Goldman, and he was making exactly that point, the kind of obvious point, which is that the longer it stays shut, the strait, the greater the impact's going to be. But he was making the point that it's non-linear. So the longer it stays shut, you get these almost irreversible effects on various costs. Insurance, for example. Plus, you've got to get the refining capacity back online, which takes longer if the refinery's been shut down. So there are these hysteresis effects and also the non-linearity, which can be a huge problem if this persists. And you can hear this in Trump's narrative. It's getting increasingly desperate.
Yeah, I wouldn't underestimate that restart risk. As I understand it with an oil well, it's not just a case of flicking a switch and back on it comes and all the barrels start coming out of the ground again. And perhaps even more so for natural gas. And we also don't know what the damage has been, like the physical damage to the infrastructure in the Middle East.
Yeah, I've noticed there was a headline today that satellite imagery from the region is no longer available unless you've got some specialized access.
Do you have specialized access, Romin?
Sadly not. I don't even have a Bloomberg terminal, but I think it's key that you can't verify what's going on in terms of shipping through the strait or what's going on in the region in terms of military strikes, unless you have that access. So any kind of open source intelligence has essentially been shut down.
The sources that I've been paying attention to say that up until now, we've kind of been using up the buffers that we mentioned in the global oil supply. But that's basically run its course. And so from here, every barrel that isn't exported from the Middle East mechanically raises the price or just results in a shortage if there's not demand destruction. So if you think about the maths, let's say there's 10 million barrels per day missing because the Strait of Hormuz is closed. Over a month, that's 300 million barrels of oil that the world is going without. Now, obviously, OPEC has said it's going to step up supply as much as it can, but it's a tiny amount, and a lot of it is on the wrong side of the Strait of Hormuz, so it's not going to save us.
Yeah, it's trapped supply, so it kind of makes no difference at all. Now, we did have a response from the IEA, the International Energy Agency. They've released 400 million barrels. That's the largest emergency release ever. The US has contributed 170 million barrels from the Strategic Petroleum Reserve. And of course, you've got Asian stockpiles too.
Yeah, but Roman, it's the point I made earlier, that they reckon the flow of that is maybe 2 to 3 million barrels a day. And we've got a gap of around 10 million barrels per day.
Oh, yeah, I just thought it would be interesting to go through some of the reserves which are out there. But you're right. I think this is just a temporary reprieve that it's going to provide. And you see that directly reflected in the oil price. Initially, when we got the announcement from the IEA, the price of oil fell below $80, but then pretty quickly it shot up again.
Yeah, I don't think there's any alternative to actually reopening the Strait of Hormuz, certainly not in the short term. You know what? To me, Romin, this feels a lot like February 2020. When we looked at China and we saw, well, everyone's working from home now. There's like lockdowns in Wuhan. We know about this weird virus, but the stock market was still at all-time highs. Bond yields were low. No one was panicking. Life seemed to be going on as normal in the rest of the world. And now here we are, we're seeing almost the worst case scenario play out in commodity markets. Everyone had always been focused on the Strait of Hormuz. For years, it was flagged as like the tail risk of tail risks. It's happened. It's shut for now. Oil prices are spiking, as are loads of other commodities, which we'll come on to. And yet, the stock market's down less than 5%. Everyone's carrying on as normal. But it feels like we're just waiting for something big to happen in markets. Do you get that sense, or am I just paranoid?
No, I think you're absolutely right. At the moment, I'd say that there's a lot of complacency in the equity market because what people are assuming is that this is going to be a temporary shock. And in fact, that Goldman strategist, what he actually said was markets are pricing in a 3-week war.
We've got a few days to finish it then.
That's right. And so, you do get these non-linear effects after that and lots of consequences because if there was one commodity that you were going to use as a rug pull for the global economy, this would probably be it.
We are starting to see some effects on the ground in the rest of the world. So you mentioned that Asia is the most directly exposed to exports from the Middle East. And that's true of oil, but especially when it comes to gas. So Pakistan gets 99% of its LNG apparently from Qatar and the UAE, 72% for Bangladesh, half of India's LNG imports come from the region. And remember that Qatar has declared force majeure and closed its LNG production facilities. So we are seeing in Asia now quite a few countries going to a 4-day week, trying to suppress the demand for oil and gas as much as they can. At the same time as a lot of EM currencies are weakening. So this is kind of a double hit to them. The price of oil and gas has gone up, which is traded in dollars at the same time as their currencies weakened.
Yeah, this often happens. The terms of trade kind of double up the effects and you get this negative spiral. To a limited extent, that's also been true of the UK. The dollar strengthened versus sterling during this crisis, and that's made oil imports more expensive because they're priced in dollars.
Presumably, if the price of oil got really high, it went up to $150 a barrel, say, we'd start to see some real severe demand destruction where industrial capacity is just shut down in parts of the world.
Oh yeah, particularly in places like the UK where energy costs are already high and where we are still heavily dependent on fossil fuels. Now, it isn't the case that GDP is so energy intensive as it was in the past. Now, the way this is usually measured is to look at how much oil is required for every unit of GDP. And that certainly has fallen since the 1980s. But it's still the case that we're heavily dependent on oil for almost every economic activity. For example, in the UK, if you were just to zoom out as an alien and just hover over the country, the bits which are moving are mostly moving because of fossil fuels. Now, as part of the research for this, we looked at a note from Carlyle Group, which made this really interesting argument, which is that oil is now more irreplaceable than it was in, say, the 70s, simply because the easy substitutions, like taking the train, turning down the thermostat, have already happened. And what's left are the uses which have no substitute. So petrochemical feedstocks, aviation fuel, fertilizers, grid balancing. So the easy wins are gone. And oil is even more precarious as an input to our global economy.
Yeah, it's an interesting point that kind of reduction of the energy intensity of the economy is a double-edged sword. Yes, we've scaled up renewables, but there's also been massive underinvestment, arguably, in fossil fuel supply over the last 10, 15 years.
But you know what I found interesting is looking back in time, because I had to research this video about energy, and I looked at which kind of historical parallels there were, because that's always a great way to analyze things. And for almost every single oil shock we've had in the past, it's sparked huge structural changes, but in specific countries. So in 73, we had the oil embargo, and France's nuclear program was built on the back of that. And now their huge energy generation capacity with nuclear energy is largely thanks to that change. Then we had the 79 Iranian revolution, and Japan's energy program came out of that. We had Russia-Ukraine in 2022, when Europe decided to diversify its LNG supply. So maybe what will come out of this is going to be another structural shift. Maybe a move more towards renewables will accelerate that infrastructure. So it's not all negative, I don't think. I think some of the things that come out of this may be positive longer term. But there's going to be pain. The longer this lasts, there's no question.
Maybe that's true in the long term. In the short term, I think everyone's just scrabbling around to find barrels of oil. So the Trump administration has basically overridden some of California's environmental laws to try and get more supply online. You've seen various exemptions from sanctions on Russian oil, particularly for India, so it can start importing. And you've seen a big push, I think, in the UK from some sectors to try and expand North Sea oil extraction. Now, that last one isn't quick, but there's a genuine debate going on about, is the moratorium on new drilling a good idea?
And we've seen politicians saying we should start things up again. So that was fairly inevitable.
Now, the IEA has described this as the biggest oil supply shock in history. So we could argue that the market reaction has perhaps been slightly more muted than you might expect, despite the massive volatility in energy markets. But maybe there's some parts of the commodity space where the reaction has almost completely flown under the radar in the mainstream press. And I think a lot of people don't appreciate how important the Strait of Hormuz is for other things, like the inputs to fertilizers, industrial gases like helium, and even the production of some industrial metals relies on imports through the Strait of Hormuz.
Yeah, I mean, there are some shocking facts around this. For example, 35% of global fertilizer raw material passes through this strait. Urea prices have surged around 30% over recent weeks. And of course, it's Northern Hemisphere planting season. So if you're a farmer, I'm sure you're all over this and terrified about the consequences for your margins.
Yeah, you'd have thought they'd have locked in their supply by now, but I read that around a quarter of US farmers have not secured their fertilizer supplies for this year yet. And the interesting thing about these kind of markets is there is no pipeline alternative. There isn't a urea pipeline, is there, to just reroute
right.
it?
Well, you can use the Faber process, but it's very energy intensive. So there's no easy way out, unfortunately, unless you've got a really cheap renewable source of energy which you can use.
But the knock-on effects of higher fertilizer costs is presumably higher food costs down the line in 3 to 6 months.
Yeah, and that feeds into inflation down the line as well. And of course, helium's a weird one because you don't normally associate the Middle East with helium, and people don't realize what it's used for. But if you're manufacturing semiconductors, it's really important. Firstly, you can use it to purge any kind of impurities, which are really damaging to semiconductor manufacture. And also, it's used to cool down semiconductors after they've been etched. So you really can't substitute that helium. So semiconductors could also be impacted. And things like AI, which depend on energy. So for example, if you have an AI data center, you're going to be paying more for the chips, you're going to be paying more for the energy to run the AI models, and of course to train them. So there are lots of unintended consequences from the shutdown of the Strait of Hormuz.
And you know that Taiwan and South Korea, where a lot of these chips are made, get almost all of their oil and gas from the Middle East. Now, helium's an interesting one because it's kind of a byproduct, in a way, of natural gas extraction. It comes from those same mines. And around a third of global helium supply comes from Qatar's Ras Laffan facility, which is now shut under force majeure. But I've become a little bit obsessed with helium lately, Robin. Not to sort of jump on a bandwagon here, but it's such an interesting commodity because it's not really traded on public commodity exchanges. There's not a spot price you can look at. And it's often a byproduct, as I said. So it's hard to get any kind of direct exposure. There are some small extraction facilities in the US which are trying to scale up their ability to produce helium. But it feels like the space where if you picked the right company and got lucky, you could strike gold or helium here.
It was funny. I always had the most interesting conversations in the green room when I was waiting to be interviewed on TV. And one of the guys was a helium mining specialist, and he'd created this fund which does exactly that. And it was so interesting talking to him because it's something I'd never even considered. And this was years ago, so I wonder what he's doing now, laughing probably.
Yes, in a very high-pitched voice. But the other issue with helium is it's not really substitutable in those processes you discussed. And MRI machines actually rely on helium as well, and it's not substitutable there.
Yeah, anywhere where you need cooling. So quantum computing is another application where you absolutely need liquid helium. Otherwise, the qubits aren't stable and you lose information. They decohere.
If the price of helium goes up and up, then there's going to be a lot of disappointing kids' birthday parties where the balloons aren't going to float. So it seems like a lot of the raw inputs to the global economy are increasing in price quite rapidly. Surely this has impacts for broader inflation. Let's come on to that after the break.
Today's episode is sponsored by Lightyear, the investment app I open my 2025-26 stocks and shares ISA with. So why Lightyear? Honestly, it fits the way I invest. The app is clean and straightforward to use, and their stocks and shares ISA has no trading fees. They've also just removed the trading fees from their general investment account and significantly reduced their FX fee from 0.35% down to 0.1%, making Lightyear amongst the lowest cost brokers in the UK. Fund manager fees still apply, but you can now trade thousands of stocks and ETFs at a lower overall cost than before. If you'd like to give Lightyear a try, use the code PensionCraft or follow the link in the show notes and you could get between £10 and £100 in your general investment account. Terms and conditions apply, details are in the show notes. And as always, investing involves risk, and the value of your investments can go down as well as up.
Okay, so coming into this crisis, inflation had been on a downward path over the past couple of years, although it hadn't quite got back to target in the UK or the US. So UK CPI stood at 3% in January. Is it nailed on now that it's going to increase markedly over the course of 2026?
I think there's an interesting point here, which actually is a mitigating factor, which is that labour markets are looser now than they were in 2022 when we had that massive peak in inflation. That's true in the UK, it's true in the US. Now, the consequence of that is that it's difficult to negotiate a higher wage if you've got a looser labour market. So that suggests that this impact will be smaller than you might expect. And of course, we've got rates which are more restrictive than they were in 2022.
So it sounds like you're less concerned with the second round effects this time, where people see the price at the pump going up, they see their food bill going up, and they think, wow, I'm going to push as hard as I can for a pay increase. It's harder to do that when there's slack in the labour market.
Yeah, because you'll be thinking, well, if I get fired, I'm not going to be able to pay the bills. So that's the kind of more pressing concern, I think, in people's minds. And I think there's going to be an effect on growth, which could also increase instability when it comes to the labour market. And of course, inflation was on a downward trend before we went into this.
But you have seen a repricing in markets of rate expectations. So before this, there was a thought that the UK is going to have a couple of rate cuts this year. The ECB might have a rate cut. The Fed's going to have several. That's all reversed. The market is now pricing in a rate hike in the UK and in Europe, and at least a longer pause in the US.
Oh yeah, in the space of 2 weeks, we've gone from people expecting rate cuts and the kind of end point of the rate cutting cycle. We've gone from that to pricing in rate hikes, which is pretty weird. So I think in the UK, we've already got one rate hike priced into the UK futures curve.
Yeah, I think it's with something like a 70% probability. But do you think that's actually what's likely to happen? I don't know. Something in me says the Bank of England is unlikely to hike. Partly because if we see an uptick in inflation, maybe it won't go straight through to core inflation. Maybe it's going to be in energy and food, which remember are the items excluded from core inflation, which apparently is what the Bank of England looks at. A lot of people are making the point that energy shocks are the kind of things central banks strive to look through, as they say. Let's not set rates based on these short-term fluctuations.
And we've got hidden technology here in the UK behind that, because since Ben Bernanke changed the way the Bank of England works, we've updated our models when it comes to how we look at inflation. And Claire Lombardelli, who's on the MPC, she's great when you hear her talking during the MPC press conferences. She's behind this update in the modeling process. So maybe that's true. Maybe we will be able to look through these energy spikes. But I wouldn't underestimate the broad effect it'll have on prices in the UK if energy prices do spike.
Every time the energy price cap for consumers gets reset, it's presumably going to have a significant step up every quarter, unless this crisis gets resolved pretty quickly.
Yeah, and you can see that priced into the gilt market pretty quickly. Usually you'd see gilts rallying as a result of these kind of risk-off moves, but both in the US, the UK, what we've actually seen is yields increasing as people price in more inflation. And the gilt market was pretty spot on, as was the US Treasury market, almost from the beginning of this crisis.
Interestingly, I think the gilt market amongst developed market government bonds is kind of the most high beta move at the moment. Yields are rising more on the bad days and falling more on the good days than any of the other markets. I presume because the UK is very exposed to gas prices and we had sticky inflation coming into this.
Yeah, I think that's right. I think those are the reasons. But one thing you can bet on is nobody's going to use that word transitory this time around.
I'm also skeptical of the argument that central banks can completely look through it, because we know that energy prices, when they go up, do eventually feed through to pretty much all aspects of economic activity through higher transportation costs, and in this case, maybe higher costs of plastics, higher food costs. Like, it's going to spread everywhere with a lag. You can just argue about what the lag's going to be.
Another impact, of course, another transmission mechanism is via household income, disposable income. If you're spending more on energy, and that includes transportation, then you've got less money to spend on other stuff, and that reduces demand for goods and services.
This is a bit of a nightmare scenario for central banks, I guess, in that it's bad for growth and it's bad for inflation. It's that stagflation scenario, which they have to make a decision. Do we care more about inflation or do we care more about avoiding recession?
Yeah, that's right. If it's a stagflationary shock, the central banks can't save you. It's likely they're going to be hamstrung by those two countervailing effects, particularly in the UK, where we were just teetering on the brink of recession and inflation was proving very sticky. And it was really annoying because it did seem like we were finally out of the woods. Services inflation was starting to fall at last, and growth was potentially starting to pick up. Now, this is going to kibosh that recovery.
And it's also going to increase borrowing costs for the UK government.
And mortgages, which is the surprising outcome of all of this.
Yeah, it's weird how interconnected everything is. So Qatar has to shut down a natural gas facility, and suddenly we have to pay more to buy a house in the UK. It's just, the global economy is so tightly bound these days.
And the fact that always surprises me is my birth was also oil dependent. If my mother hadn't gone out to Iran with someone she married in Birmingham in order to escape the UK, she wouldn't have met my dad.
It's quite the oil shock.
Yeah.
So I think it's fair to say that there's huge volatility across lots of different asset classes. We know there's been a big rotation going on in stock markets even before this started. And most people are focused on the potentially negative aspects for the portfolio. Everyone knows that stock markets could take a leg down. Valuations are stretched in the US. If we get a protracted energy price spike, something's going to have to give, you'd have thought. But with all of these kind of crises, people do start looking for opportunities. And I thought it was super interesting that there's been a record inflow into oil ETFs from retail investors. I even saw on the PensionCraft forums, a couple of people who made tactical trades investing in 3 times levered oil funds and got in and out within a few days and made a reasonable amount of money.
Yeah, I mean, I generally don't do that. I did kind of dabble with leverage when I was kind of playing around with Nvidia and Tesla. And I just resigned that to the bin of stuff which I can't stomach. I just don't like the volatility and I don't like it when it goes wrong. I hate that sick feeling when you make a large loss, even if it's like for £100, I just can't live with it.
It is gambling.
It is gambling, and I'm not a gambler.
I think we have the most volatile oil market in history. So to go in with 3 times leverage on top of that, it doesn't take much to wipe you out. And I guess this stresses the importance of really seeing the difference between your core portfolio, which you shouldn't really be touching, and any tactical trades you want to make on the side, maybe in a fund portfolio.
Yeah, look, I always say this, and I always will, which is don't panic. Because if you do make decisions for your core, when you're scared, you'll make bad decisions. And you should always build your core so that you can weather a 40% fall. And just assume that 40% fall is going to happen at some point.
You mean a fall of 40% in equities, right? You can structure your core so you shouldn't feel that in the whole portfolio if you can't stomach that fall.
Yeah, exactly. You should understand that equities are jumpy, and whenever crises happen, which they always do, they will fall 40% at some point from the previous all-time high. So don't fiddle with the core, don't panic, don't get stressed, and don't make decisions based on that stress or worry, because you will make bad decisions.
I agree with that. And as you've said in the past, one way of sticking to that is to focus on your fund portfolio in times like these. Yes. Now, I'm interested, have you made any tactical trades around all this upheaval?
No, my plan actually was if it gets worse, which I think it might, I've got a huge cash stockpile ready for this kind of crisis. Half of my fund portfolio, you always joke about this, Michael, half of my fund portfolio is in cash. So it's precisely for this kind of crisis. So what could I buy? Well, I've got things on my list. One thing which I've been looking at recently is drones. So embodied AI and drones. So I think that could be a really interesting long-term trend. So if the price of that comes down, I'd definitely be thinking about building that up.
Isn't that the kind of thing that's unlikely to fall, though? Defense stocks, especially those innovative ones, even if the broad market falls, are probably the ones that are going to be more resilient.
Yeah, true. I think the obvious beneficiaries are going to be defense stocks. So that theme will probably stay expensive. But I think the broader embodied AI might start to fall. Also, investing in AI more broadly, I think that also is going to fall because of many of the structural problems which are going to happen because of increased energy prices, chip prices, overspending on infrastructure and hyperscaling. So I think that could be an interesting long-term trend now. Another one which I'm always looking at is credit, because I think there could be a credit shakeout on the back of this. A lot of banks have lent to oil companies. Oil companies have been borrowing in the high yield market. And so I think that energy exposure could make that sell off. And that's usually an interesting play. So there are a couple of things I've got on the back burner, but for me, it's long only. I probably wouldn't use leverage, and I'd probably just buy things which I wanted to buy anyway, because that just suits my temperament much better. How about you?
5 times short everything. No, I mean, I've been looking at the weird stuff, right? Because for me, the fun money is to do things that are really niche rather than just going out and, I'll buy Shell because it'll do well. So I've been looking at helium stocks. And the interesting thing here is a lot of them are so early stage, like they're drilling at the moment. The extraction facilities are just coming online. They're trying to secure buyers for their supply. And a lot of these are kind of binary outcomes. Like no one knows what the kind of density or quality of the helium is going to be. And I'm also looking at some junior miners, especially ones which were weirdly distressed coming into this episode, where they were unprofitable and probably going to go bankrupt when oil was $60 a barrel at the start of the year, but could be wildly profitable if oil is $100 a barrel for the rest of the year. It's almost a binary option outcome where it's non-linear. It's a gamble, you know. It's not the kind of thing I would put much money into. The other interesting thing I think is shipping, where you might think, okay, that's going to be negatively affected because their fuel costs have gone way up, their insurance costs have gone way up. But tanker freight rates have surged massively, and it more than compensates for that risk. And also, they have to take much longer routes because they can't go through the Strait of Hormuz anymore. Good. So they're going around Africa, and they'll be billing for massive journeys. There's also some ships stranded, so there's competition for the remaining fleet. You've basically got these two forces pulling in opposite directions, and like, which one is going to win?
That's an interesting list. I think a good playbook for any kind of crisis for your fund portfolio would be measure what hurts most going into it, and that's usually what bounces most coming out of it. So airlines and shipping, automakers, food delivery, retailers, paint companies is an interesting one because their raw materials are often oil derived. Tire manufacturers, home builders, you know, a lot of these I think could be interesting coming out of the crisis. So you could kind of build a basket which is based on those themes.
The recovery play, sure. It depends if you think it's going to recover quickly. There's an argument to say it might not if those are very exposed to energy costs and oil prices, because I think there's going to be this dynamic long term where countries are going to have to rebuild their strategic oil reserves, and probably to an extent greater than before the crisis, because everyone's going to be nervous now about oil. So you've got this huge potential institutional and government buying of oil, which I could see pushing up the long-term price of oil, not to $100 a barrel plus, but higher than it would have been in a counterfactual where the war didn't happen. And also countries are going to be looking for diversification, right? So I think if you can find companies which are extracting oil and it has nothing to do with the Strait of Hormuz or Russia or any of these kind of sanctioned places, maybe in America, maybe in California, if the environmental regulations are going to get watered down, maybe in West Africa, there's these places where they're strategically positioned and they could benefit, but it comes with country risk.
Yeah, Malaysia might be an interesting one because that's based in Asia. I'll tell you another one which is interesting, gilts, because gilts have sold off because of the inflation spike. So the yields are now more attractive. So that could be interesting for some people.
Would you not be worried about duration risk with gilts?
Oh, always. I haven't got any gilts, single gilts at the moment. I've got a short-term exposure to gilts, so the very short end of the market via funds, not individual gilts. But I'd certainly consider switching into it as part of my safe piece of my portfolio.
What, into like a 10-year gilt?
Yeah, it could be, or it could be a gilt ladder just to park things safely. So my safe bucket, I could switch it out to gilts if it got more attractive. Not at this point. I think if it spiked further, it could get interesting.
We'd basically be making a bet on UK yields falling over the medium term. I don't know if that's a bet I would make.
What essentially you'd be saying would be that inflation and growth in the UK, either or both, is going to fall. And I think there's a fairly good case to be made for both. But for me, it wouldn't be a tactical play. It wouldn't be some kind of view on what's happening. I'd hold them to maturity and it would just be a kind of safety buffer for me.
I guess if you're holding to maturity, you're not going so far as a 10-year gilt then.
No, I might not make it.
What about gold? Like, that hasn't been the safe haven people usually think of during this crisis. It has lost a little bit of value.
Yeah, it's been kind of flat, down a little bit, but that's because of the countervailing effects. I think it does have this safe haven bid, which probably has tried to push the price up. But then at the same time, you've got the strengthening dollar, which has the opposite effect. And you've got rising yields, which has the opposite effect. So I think those won. But if you do think gold's an inflation hedge, this is just another example of the many which shows that that's not true.
I guess with all these trades, the thing to bear in mind is, do you have an edge over the market? Because there's so many obvious trades. People are piling into oil and gas, benefiting from the spike in prices potentially. But if you do that now, you're in a crowded trade, and it's obvious, like it's not something you've spotted before anyone else. You might have higher conviction in it than most people. But I think you've got to ask yourself, why would I make money on this? Why is the market wrong now?
Yeah, I think that's true of all tactical trades. And whenever someone comes up with one of these schemes where they say, look, I've thought this through, this is my plan, that's what I always say to them. What's your edge? Have you got one? Because the chances are you've come across this idea late, and there are hedge funds doing this well before you. Whereas if you are long only like me, I think having that market crash shopping list, find themes that you believe in and buy into them when they're cheaper, because that overcomes a lot of the psychological difficulties that people have going through these crises.
Do you remember the day before the US attacked Iran? I said to you, I've got my eye on this European gas ETF. Just got a feeling. And then I didn't buy it. And then the next day it went up 40%. And do you remember how angry I was, Romin?
I do remember that. That was amusing.
So FOMO is real, but I haven't overreacted to the FOMO. And I've stayed sane.
But presumably you'd only put a small amount in anyway, isn't that right?
Yeah, it would just be a little fun trade.
So it's worth recapping what not to do in these kind of crises. Don't panic sell into weakness. The sell-off isn't huge yet, but eventually it could get bigger, but don't panic and sell into that sell-off. Don't try to time the oil price because, like Michael said, you haven't got an edge. And oil is notoriously volatile. Every bit of news flow is going to make it swing one way or another, and it could be very stressful. Don't assume it's 2022 all over again because the macro backdrop is quite different this time. And usually remember that equities reprice these shocks very quickly if there is a turnaround because they're forward looking and they could snap back higher very quickly as a result of that. And you could be locked out of the market if you've sold. So stick to your plan, keep it simple. If you are going to muck about, do it in your fund portfolio. And whatever you do, don't panic. Now, we mentioned the discussion in our chat application amongst the community about how to respond to this crisis. If you wanted to join that conversation, then it's really easy. Just go to our website, pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Does the futures curve predict where prices are going to go in the future?
Now, most of the time, we don't use the futures market. It's usually to do with commodities. But the idea is that instead of buying today in today's market, what you do is you enter into a contract where you agree to pay a fixed price or receive a fixed price at a fixed point in future, at a fixed place in future, for an agreed quality of some commodity. And this is an immensely deep and liquid market. It's very actively traded. Professional investors mostly are the ones that trade in this market. But you can almost take the entire futures market and split it into two categories. One category would be things which you can store, and the other category would be things you can't. Now, if you can't store something like gold, then the futures price is dependent on that storage cost. It's called the carry cost. It's got absolutely nothing to do with predicting where the future price is going to be.
But let's talk about oil, because that's what everyone's focused on at the moment.
Which you can't store because oil does go off. You can store it temporarily, but you can't store it indefinitely. Now there, people sometimes mistakenly, again, think that it predicts what the price is going to be in future, but that's not true at all. It's driven much more by supply and demand dynamics. So sometimes you'll do anything to get your hands on a barrel of oil today, and that can push up the short-term end of the curve.
That's kind of the dynamic we have at the moment. So the spot price of oil, like Brent crude, is like, as we record this, something like $105 a barrel. Whereas if you look on the futures curve for the end of the year, it's more like $75 or $80 a barrel. Now, I've seen some people saying that means the market expects prices to fall over the coming year. Is that a misunderstanding?
Yeah, that's Futures 101. That's really mistaken thinking. Just because the futures price, which has been agreed in the market today, and that's a critical thing, it's a snapshot today, that doesn't mean that that's where the price of oil is going to be in future. That'll be driven by loads of factors to do with supply and demand, geopolitical shocks. So it almost tells you nothing, I'd say.
So what is the futures curve telling us then? If it's not a prediction about where spot prices will be in the future, what is it?
Well, like I say, it's a snapshot of sentiment based on today. And there's a nice metaphor here, perhaps, which is to look at room prices in a hotel. So let's say that a room tonight costs £200, a room next Tuesday costs £150, and a room in June costs £90. Now, that doesn't mean that the hotel's going to cut its prices from £200 to £90 over the next few months. That would be ridiculous. All that means is that right now, tonight's room is more expensive than a room in June, probably because demand is higher for immediate bookings. So if you check back next week, then you wouldn't expect to see a price that's different from £200, despite what the futures market for those rooms is telling you. Now, for the oil futures curve, it's exactly the same. It's just a snapshot of the price of oil for delivery in different months as it's priced today. Think of it like a menu of prices at one moment in time. It's not a trajectory that's being priced in.
Okay, that all makes perfect sense. So we can't read off future prices from the futures curve, which makes me think they should have called it something different. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.